With fixed rate mortgages on the rise, adjustable rate mortgages are starting to look like a more attractive option for home buyers. Remember, I'm not here to promote or encourage any specific loan type. In fact, any loan out there can be bad if it's not going to help you achieve your financial goals. That's why today we're going to break down the difference between fixed rate mortgage as well as an adjustable rate mortgage so that you can figure out which one would be best for you. So let's get into it. Rather than reinventing the wheel and making my own kind of compare and contrast chart, I found this great one that I want us to reference from Investopedia. So on the left side here, you can see fixed rate. Now, the fixed rate mortgages, they're going to have a set rate of interest that does not change throughout the entire life of the loan. So whether you're getting 10, 15, 30-year loan, your interest rate will not change. It says typically this makes it easier for homeowners to budget. That's because that interest is not changing. It's not affecting your monthly payment. Once you go under contract, you close on your fixed rate mortgage, your payment could only change based off of like your home insurance or your taxes. In addition to this, it provides protection from sudden changes in mortgage rates, and it can be difficult to qualify for if interest rates are high. Now let's turn over to adjustable rate mortgages. The rate is set below the market rate on a comparable fixed rate loan that rises or possibly lowers over time. AKA, with an adjustable rate mortgage, your interest rate will change over the life of your loan. So whatever your duration is of the overall loan, is it 10, 15, 30 years? There are going to be increments in there that your interest rate will change based off of what interest rates are doing. So your interest rate could go up, it could go down. Typically, these are a little bit more complicated than your fixed rate mortgages because not everything is staying the same the entire duration of your loan. They are much cheaper than a fixed rate mortgage, at least in the first 3 to 7 years, because of this first point. The rate is going to be set below the market rate. So you are going to be paying less in interest on the front end. The monthly payment can change frequently, making this difficult to budget for. Touching a little bit on fixed rate mortgages, which is the majority of the content that I make on this channel, versus adjustable rate mortgages, which loan would be right for you? The first thing you need to ask yourself is, how large of a mortgage payment could you afford today? The second thing, could you still afford an adjustable rate mortgage if interest rates rise and go up? Remember, at certain time frames in an adjustable rate mortgage, your interest rate could be subject to changing, and that means it could go up. 3, how long do you intend to own the house? In my opinion, this is the most important factor that you need to consider if you are weighing the pros and cons of an adjustable rate mortgage. So you can think about it this way. If interest rates are high right now, but experts are predicting that they are going to fall, an adjustable rate mortgage may be advantageous at that point because you're not locked into today's rates, which are higher. And at the time that your interest rate is reassessed, they may be lower. Well, in that case, that's a great thing. But if interest rates are currently low, obviously, you might want to lock that in with a fixed rate mortgage. And let's look at a quick example of this. Let's just say, for all means and purposes to keep everything equal, that you were trying to buy a $300,000 house and you are going to put a 20% down payment. Let's say that you were going to lock in a fixed rate mortgage. So right now, interest rates may be about 5.45%, and you're going to get a 30-year. You do not need to include the PMI. So just for your principal and interest, not counting your taxes and insurance, you're looking at a total monthly payment on that of $1,355. Now let's look at how this could change if you were going to get an adjustable rate mortgage. Now, adjustable rate mortgages, they differ on how quickly the interest rate will reassess. For some loans, it can start a few months after you close. For other loans, it may be 1 year up to 10 years down the road. So it's very important to understand, if you are interested in an adjustable rate mortgage, how quickly your first reassessment of that interest rate is going to be. But let's say that you have the opportunity to get an adjustable rate mortgage where your interest rate will not be reassessed for, let's say, 7 to 10 years. So you're going to be able to lock in a pretty low rate, a below market rate right now, while interest rates are kind of going up. And then later down the road, depending on what the market rates are doing, your rate would change at that time. So let's say you decide to go with one that will be the same for the first 10 years. You could probably lock in, let's say, a 3.5% interest rate because they're going to give you one that's below the current market rates. That would bring your payment down by literally $300 a month. It would bring it down to just over $1,000. Now, this is important to note because if you go with an adjustable rate mortgage with a longer period of time to where it's essentially fixed and then it does not reassess until it's down the road a little bit, you're saving $300 a month for years. And that can be a huge benefit depending on how long you plan on staying in the house and what your goals are. So now that you can see the difference on a monthly basis and kind of the pros and cons of both a fixed rate versus adjustable mortgage, I want to talk about who the best candidates would be for an adjustable rate. You'd be a great candidate for this if you are planning on being a short-term owner of the house. So the fixed rate portion of the ARM varies from a few months, like we talked about, all the way up to potentially 10 years of a locked fixed rate. If you don't plan on owning the home for that long, an ARM can make a lot of sense because let's say you know for sure that you are going to be moving in 5 years. Okay, well, if I'm going to be moving in 5 years and selling this house, then whether my interest rate is going to change at 10 years doesn't affect me because I would have sold the house and paid off the loan prior to that. If you are in that situation, an adjustable rate mortgage is not necessarily risky because you are able to lock in for the entire time you plan on living in this house a very competitive interest rate, an interest rate that is below the current market rates. A perfect example of this would be someone who's buying their starter home. So if you are buying your starter home, but you know that this is just a temporary house for you and that you're going to want to buy something bigger when you get married or when you have kids, this would be a perfect solution for you. As long as you plan out and are very aware of when your interest rate will be reassessed and possibly can change and you plan for that. The next individual that ARMs can be great for are people who have an increase in earnings coming up, or at least in the foreseeable future. If you expect your income to increase over the next few years, an ARM can save you from paying thousands of dollars in interest. Perfect example of this would be people who just graduated from medical school or law school. You may need an affordable payment now, but you would be able to cover a higher payment if you stay in the house in the event that your interest rate does go up when it is reassessed. The next people an ARM is great for are the pay it off people. If you are someone who has a plan to pay off their loan early by making extra payments, this can be perfect for you. And you know, if you are one of these people, sometimes I meet with clients and they're like, we've got it all worked out. If we have a payment of X amount, we're going to make extra payments or divide our payments up and we're going to pay the whole thing off in like 7 years, 8 years. Like if you are one of these people who wants to get rid of the debt of your loan, this can be a great solution for you so that you're paying less in interest overall. Additionally, this could be good if you are going to be buying a house before selling your current one. And then once you sell your current home, you're going to be putting that equity towards your next house by making extra principal payments to bring down your loan balance. This can also be a great opportunity for you. The main thing that is important to know about fixed rate mortgages versus adjustable rate mortgages is don't go with an adjustable rate if it is the only way that you can afford your dream home. That is how you are going to get yourself into trouble. Obviously, adjustable rate mortgages are going to be enticing because of their low upfront rate. But if you're locking yourself into that because that's the only way that you can afford the total price tag of the house that you want to buy, you could easily screw yourself over if you're still in that house when your interest rate changes and your interest rate hikes up. Then you can no longer afford your house payment. The last thing that I think is worth noting when it comes to adjustable rate mortgages is that some people hold on to the fact that adjustable rate mortgages were common leading up to 2008. Now, Adjustable rate mortgages did not cause the housing crash in 2008. There were a lot of predatory lenders out there who were giving people loans that they could not afford. And they were not explaining that adjustable rate mortgages can change and you will be responsible for whatever that payment goes up to. If you are considering an adjustable rate mortgage, definitely get some guidance from your family, your friends who understand this stuff. Do your own research, read the fine print, and make sure you understand how quickly your interest rate could potentially change. And I want you to understand too that there are set caps for these changes. For example, usually it may be like your rate can go up by 2% max. And there will be a cap in your disclosures as well that you are aware of. So it doesn't mean that you can go from being locked in at a 3% all the way up to 12% in 1 year. You're going to be protected from that. They're not trying to make you lose your house by any means. But if you are a savvy home buyer and you're interested in paying as little as possible in interest over the long term, an adjustable rate mortgage may be something to look at as fixed mortgage rates continue to rise. Let me know in the comments below what your thoughts are on adjustable rate versus fixed rate mortgages. I've personally never had an adjustable rate mortgage because every time I have bought a house in my life, interest rates have been fairly low. So I've wanted to lock in the fixed rate for the life of my loan. But I'm interested to know what you think of this. If you are not following me on Instagram, make sure to go over there and do it. I post additional content over there. And I've been having a lot of fun making reels recently, and I'd love to know what you think of those. I'm Nicole Nark, Arkansas real estate broker, with videos to help you find your way home, and I will see you in the next one.